Here we go. How do you reduce your taxes? So your financial life is going to happen, right? You're going to move forward in life. Things are going to happen. You're going to make financial decisions, and you're going to end up somewhere in the future. And I like to think of the options as these two places, door number one and door number two. Door number one, you're able to afford to do everything you want in life. Door number two, you miss out on doing things that you want in life. You're going to have a financial life. Whether you get to do everything you want depends on a lot of things, but without planning and some foresight, it's very, very difficult to get to that door number one. And that's what we're talking about today. We're talking about financial planning. In today's context is about taxes. There are four areas of your financial life. Protect what you have. That's insurance and estate planning. Know where it goes. That's your spending. Super important because you want to maintain your lifestyle, so you have to know what it costs. Number three, make it grow. That's your investments. You want to have your investments working for you, though. That is the engine of your financial plan. And four, retain independence and dignity. That means we're not going to live off our kids in our old age. We're going to make decisions today in the context of how they will affect us long into the future, because that's what will happen is our financial decisions today affect us. We do all of this with intention and purposeful effort, and we're building our best financial life. That means it's your best financial life, not the best financial life on your block, not the best financial life among your friends and neighbors, but the best financial life, the one that fits you and who you want to be. The process that I use is this. We go through everything holistically. It all fits together. Your insurance, your spending, everything. Your cash flow forecast, your investment structure, and really the projections of where you're going to be. That's the magic sauce, because then you can really start asking the what ifs. And you can see we don't really get to that until we've looked at everything else and put it together. And then going forward, we gotta keep it up to speed. We've got to be checking in on what it is. So today we're talking about taxes. So where do taxes fit in all of this? What do you think? Everywhere. Taxes are in every part of your financial life. Now, our goal is not to always minimize the tax we pay today. Our goal should be to take more home with us, keep more of our assets to use for ourselves over our lifetime. Some of the things we're going to talk about today in terms of reducing taxes are actually going to cause you to pay more tax today, but over your lifetime, the idea is that you'll pay less. Now, if there's one thing that I want you to remember about taxes in general, it's this: having an even income across your life. That is what's going to minimize your tax, because we have a graduated tax system, meaning that the rates go up, right, as you earn more income. So if you know how much money you're going to make over your entire life, if you can take that and divide it by the number of years you're going to work and just earn that flat amount each year, that's going to give you the lowest tax possible. So that's a starting point for how to think about your income and moving income around. Not always the case that you want your income level, but generally speaking, you want your income to be exactly the same across time. Now, we're right in the middle of, I'm not sure what you would call it, but it's the, seems like the quadrennial activity of rewriting the tax code. So Congress is working on new tax laws. None of it is good news in the terms of lower rates. It's all higher rates. But of course, for those people making higher incomes as well, that's really what it's going to apply to. Let's see here. So that's the one thing I want you to remember. But here's 5 techniques that you can use. Number one, Roth contributions. So Roth accounts are never taxed as long as you follow the withdrawal rules. In other words, as long as you use them for retirement for the most part. So you put money in a Roth, you pay tax on the money you put in, you don't get a tax deduction. So that's the downside. You're paying more tax today. But the Roth balances will grow, hopefully. And when you take money out, you don't pay any tax on that growth. That's one of the few areas where you can get real tax-free income of any substance. there's no, there are income limits on Roth IRAs, and you might be over those, but there's no income limits for Roth 401k. So if your employer offers a 401k Roth, really consider putting money into it. Now, you want to do this in your lower taxable income years. Remember the idea of keeping your taxable income level. If you have a year where you're going to have a dip in taxable income, let's say you take some time off between jobs, or maybe your spouse takes some time off, or whatever it is, that's the year to really load up the Roth. Pay the tax that year because you're likely to be in a lower tax rate. So that's number one, make Roth contributions. Number two, somewhat similar, Roth conversion. So here we're converting our traditional IRAs into Roth. Now, what does that mean? Well, if you have an IRA, which would be maybe from an old 401k, let's say you have an IRA with $100,000 in it, you can convert that to Roth. You'll show $100,000 in income this year, and you'll pay tax on that out of pocket. It won't come out of the account. But again, now you've got $100,000 in Roth. It will grow, and you'll take money out and never pay tax on the growth. So that's a really good way to get money into a Roth too. Again, obviously you want to do that in a low income year. Now, if you have basis in your IRAs, meaning if you have made contributions that for which you did not take a tax deduction, this is not going to work for you because the IRS doesn't segregate IRA from IRA from IRA. They look at all your IRAs at once. And so you're not going to be able to do this conversion. But if you have IRAs with no basis, meaning they're all, pre-tax money, 100% pre-tax money, this is a great way to get money into a Roth. You'll pay less tax over time, most likely. Now, I should caveat all of this with the fact that tax laws change, right? They're changing potentially this year. They're going to change again in 4 or 5 years. They're going to change again in 4 or 5 years from there. So a lot of times we end up with money in our taxable accounts and money in our traditional accounts and nothing in Roth. Well, if the tax laws end up favoring distributions from Roth when you retire, it's going to be really good to have Roth balances. So I'm not saying that will be the case. I'm saying that it's good to have money in all three buckets so you're diversified. No matter what the tax laws do, you're covered in terms of a good strategy for withdrawing funds in retirement. Number three, tax location, asset location. Now we're talking about your investment portfolio and where your investments reside. Remember, there's 3 different types of accounts. There's regular taxable brokerage accounts. So that's just money you take from your checking account, you put it into a Charles Schwab or a Vanguard account, and you start investing it. That's a taxable brokerage account because you're being taxed today on what's going on in there. There's traditional 401ks and IRAs. Those are accounts where they have pre-tax money. You put money in, you took a tax deduction. So when you take money out, you're going to have to pay tax. And then there's the Roth that we've already talked about. So which investments go in which? Well, for taxable accounts, we want very low turnover, low income investments. So that's our growth investments. That's our low dividend stocks, the ones that are really going to power the growth of our portfolio over time. The traditional IRA, we want the higher turnover strategies, higher income investments. And I like the higher income investments there because the higher income investments usually don't have a lot of growth associated with them. So we can take the income in that account. This account's not going to grow as much as our growth account, our taxable accounts, but we're going to be able to accumulate that income without paying tax on it as we go. We'll have to pay tax when we take it out. And then the Roth IRA and Roth 401ks, well, that's where you want your supercharged investments, right? That's where you want the most of your growth because you're not being taxed on any of that growth again. So think about that. Think about your asset location when you think about your portfolio structure. It can be very important. Okay, let's shift gears a little bit and go to number 4. Group your charitable deductions, your charitable donations. This is for people who are giving to charity as part of their overall life plan already. For those of you who are not doing that, let me just say very clearly, you cannot give money to charity, take a tax deduction, and come out ahead. The tax code doesn't work that way. But if you are already giving to charity, there are ways that you can maximize the amount of tax deduction that you get, and grouping your donations is one way. Here's how it works. The standard deduction for families right now is about $26,000, 25,550. What that means is that if you don't itemize your deductions, you automatically get to deduct 25,000. That's the standard. If you do itemize, and you have to itemize to take charitable deductions, and let's say you give $20,000 a year, like in this example, you're never going to hit that 25 limit. Now, you may have other deductions, mortgage interest, and other things that put you over, but just thinking about the charitable deductions, you might not get there, which means you're going to give 20,000 every year, and you're going to take a deduction of 25,000 every year because that's the standard. Well, what if you grouped them, and in one year you gave 40,000, the next year you gave 0, the next year you gave 40, the next year you give 0. Well, in that case, you get a $40,000 deduction in the first year, then you get that 25,000 deduction in year 2, then 40, then 25. Much better than 25 every year. So there's some strategies around this. Now, you don't have to give it all to the end charity. You can use a donor advised fund. Those are really popular and a great, easy way to give money today, get the tax deduction today, but you can name the actual charity later. The funds basically sit on the side. You can't touch them. They're not for you, but you get to control the investments and you get to control who to give those funds to. So that's a really great, easy strategy for those of you who are charitably inclined. All right, number 5, company stock sales strategy. This one can be very important too. Depends on what type of stock you get from your company. But in any case, you should understand how the taxes work on all your stock. And next month, I'm doing a webinar on ESPP, so please join me for that. But let's just talk for a second about RSUs. RSUs, one of the most commonly misunderstood facts about RSUs is this. When an RSU award vests, you are taxed on it. And you're taxed like ordinary income. And so it's just like a paycheck. But what do? You probably don't sell the stock. So what does that mean? That means it's like the company paid you a paycheck and you took 100% of it and turned around and went and bought stock in your company. Now, would you ever do that with your paycheck? I'm guessing not. But that's what you're doing if you're holding on to the RSUs past the vesting. Now, a lot of people will say, yeah, but you want to do that so you can hold it for a year and get a lower tax rate. That lower tax rate only applies to the gain or loss from date of vest to date of sale. If you sell on date of vest, there is no gain or loss. And so that's why this is that's a great potential ongoing strategy, is to sell those RSUs as they vest. ISOs, incentive stock options, very complex. Non-qualified stock options, a little less complex, but you should understand how your awards, if you have an ESOP, whatever it is, how they're taxed so that you can create a strategy for each award. So those are my 5 tips for reducing taxes. Please, again, throw your questions in the chat or the Q&A. Happy to get to them here in about 4, 5, 6 minutes. Okay, great. So that's all generic stuff. But what about you? So here's what I want you to do. Tomorrow, you're going to get an email with a link that's going to allow you to download these slides. Download the slides, look through them, think about this conversation, consider how you are or are not taking advantage of these 5 ways to reduce your taxes, and schedule a call with me. Because you're attending this webinar, I'm offering a free coaching session that's a $300 value to talk about your taxes. I'm happy to do that. In fact, I'm going to put a link in the chat right now, assuming I type the right one. Oops, that's not it. There we go. So there's a link right there. You can go ahead and schedule time with me. You'll see I'm blocked out the next 2 weeks because I'm going to Mexico for 2 weeks. I can't wait for a little vacation. I hope you're getting ones too. Again, this free coaching session, I want to be clear what this is. This is about you and solving a problem or challenge that you have, this time about taxes. This is not a sales pitch. I promise I will not give you a sales pitch during that conversation. I just want to help people with their taxes. It can be the topics we talked about today, or it could be some other tax related topic. Happy to have that conversation. So let me just wrap up. You should know that this is not financial advice. Financial advice is specific to you and your situation. I can only give financial advice to my clients. So don't think of this as Joe is telling me to do this or do that, just providing general information. and what I call money moves. I mentioned I'm doing a webinar next month on ESPP. Here are the topics of the webinars I've done in the past. I'm happy to share those with you if you want to go back and take a look. But I do these every month. And like I said, next month is how to manage your ESPP. I also have a weekly podcast, very short podcast, like 2 minutes, and it's just a money tip. Feel free to, you can find that everywhere you find podcasts, Spotify and iTunes and everywhere else, and a weekly blog as well. And if you just have questions, email me. You can reach me at joe@bestfinlife.com. Happy to have some email back and forth about whatever situation that you're concerned about. The email address looks a little odd, bestfinlife.com. Let me explain that. It's BESTFINLIFE because it's Best Financial Life is the name of my firm, but I'm too cheap to pay the $8,000 to get that URL. So I shortened it to Best Fin Life, and that's just working just fine for me. And there's the disclosure. So that's all I've got for today. I will now turn it over to questions a little bit early, give you back 3 minutes of your day if you're inclined to take off. Otherwise, please throw your questions in the chat or the Q&A. I'll just give that a second. Okay, here's one. Is there a limit on how much of an IRA you can convert to a Roth in any given year? Wow, I don't think so. And here's why. Think about what you're doing. When let's say you have a $2 million IRA, you convert it all to Roth. Guess what? You got to pay tax on $2 million of income today. The IRS likes that, right? So I don't think they put a limit on that. Although, of course, IRAs are under great scrutiny these days with the Thiel IRA. That's how many billions of dollars in that Roth IRA. So there's going to be some changes around the Roth rules, I believe, in the next version of the tax code. But to answer your question, I do not believe there's a max. If there is a max, it's got to be really, really high. So there's not like an annual challenge to that. The challenge with converting traditional Roth is what I mentioned before. If you have any basis in your IRAs, if you have any dollar amounts in your IRAs for which you did not take a tax deduction, that's going to mess up the whole conversion. You're not going to want to do that. If you're wondering, do I have that? I don't know. It would be reported in your taxes. It would have been reported at one point on a 1099, and it would be in your tax forms, your big tax packet. And I'd be happy to take a look for it if you want me to take a look at your taxes and tell you if that's the case. Okay, next question. Let's see. Actually, I don't see any other questions. I'm going to give it just a couple more minutes. Maybe somebody's typing out there. We do have good attendance today. I appreciate it. And again, I really do appreciate all of you taking time to work on your own finances. It's important, but it's also doesn't always feel urgent, and it doesn't always feel like a lot of fun. So I do appreciate your time. Okay, here we go. Here's a question. If I had a traditional IRA from a few years ago and had significant growth, and another IRA that's non-deductible this year, if I convert to Roth IRA this year, how do the taxes work? Yeah, you don't want to do that. And here's why. What the IRS says is they look at all of your IRAs as if they're a single IRA. Doesn't matter how many you have, doesn't matter where they are, they know it because it's all being reported to them. And if you have, let's say you have $100,000 in two IRAs, and one of them is deductible and one of them's not deductible, and you convert the non-deductible to Roth, thinking that you're going to be able to do that without paying tax, no dice. The IRS does it pro rata. So what they say is really, okay, you converted 100,000, but you really converted half of your basis IRA and half of your non-basis IRA. So they're gonna charge you tax on the half that they're saying has not paid tax yet. Now, that's with you if you have 100,000 in one, 100,000 in the other. My guess is that's not the case. You may have $1 million in one, and you may have 10,000 in the other. So now you're going to only get the tax benefit, the non-taxable conversion of a tiny, tiny sliver. So yeah, I would not even do that. A better case, if you want to get money in your Roth, a better way to do that is if you work for a company that offers Roth 401k, do that. Put money in your Roth 401k. There's no income limit for that. And most companies allow you to actually do that over the limit. So the 19,500 annual limit, you can actually put in non-deductible contributions into your traditional over 19.5 and have that immediately convert to Roth. So you could put up to 30, 40, 50,000 in there. Just, I think the cap is 56,000, something like that. But that 56,000 cap includes employer contributions. So just be careful, don't cap it out. But you can definitely put a lot in Roth if your employer offers such a thing. All right, any other questions? Again, don't see any other questions. A lot of shy people here. Great, so you already do the after-tax 401k contributions to the Roth in-plan conversion. You're doing the best you can. I think that's great. You know, the only other thing that you could consider is if you want to take your traditional IRA for which you did take a deduction and move that into your 401k. In other words, get rid of your IRA that has that does not have basis. Then you could probably make it work, but that may not be worth it because 401k options usually aren't that great, and so now you're investing not so good on that big traditional. But happy to talk about that with you if you'd like. Okay, here's another question. I had a Roth 401k at my previous employer. I recently chose to roll over my Roth 401k to my new employer's traditional 401k. In theory, I would not need to pay any tax this year on growth or employer contributions as it's going directly into a new account. Is that correct? Well, so just to clarify, you had a Roth 401k at your old employer and you moved it to the 401k of your new employer. Your new employer should have put that in a Roth 401k. Now, you may not know that, and that's okay, because most places like Fidelity and Morgan Stanley and those guys who E-Trade, who run 401ks, they'll report it combined. So it looks like it's all in one bucket. So that may be what you're doing. You may be looking at it and saying, oh, it's all in the traditional, but it really shouldn't be. It would be worth checking. If it's an E-Trade or Fidelity, I think you could just call them up and ask, but it should be in a Roth 401k, meaning it went from a Roth to a Roth, so direct transfer, didn't go through your hands, there's no tax, no issue. It does get reported to the IRS, so the IRS knows where it is, but there should be no tax on that. So hopefully that's the case. These guys are really good at paperwork, so my guess is it's just fine. But if you're worried about that or concerned about it, just give them a call and ask.